The collapse signal. 6,800 ounces of silver, the number that's collapsing. What if the most important warning sign in the entire economy isn't the stock market, isn't inflation, isn't even what the Federal Reserve says next, but a number almost nobody is tracking? It takes thousands of ounces of silver to buy the average American home today. That number has been falling for years. And in every era of history where that number started collapsing quickly, something much bigger was already underway. By the end of this video, you'll understand exactly what that number means, why it's been shrinking, what happened the last time it moved this fast, and what it could be quietly telling us about where money is headed next. This isn't about predicting a crash for entertainment. It's about understanding a relationship that's existed for over a century, the relationship between hard money and real assets, and what it reveals when that relationship starts to break. Most investors are watching the price of silver in dollars. That's not the real story. The real story is what silver can buy, and right now, that's changing faster than most people realize. Here's the simple version. To figure out how expensive a house really is in silver terms, you take the median home price and divide it by the price of an ounce of silver. That gives you a number, how many ounces of silver it would take to buy that house outright, with no mortgage, no bank, no paper currency involved at all. For most of the last few decades, that number has been enormous. Homes have required tens of thousands of ounces of silver to purchase. But ratios like this don't move in a straight line. They move in long, slow cycles, and then, occasionally, very fast ones. And that's exactly the kind of move some analysts believe may be forming right now. But here's where things become interesting. This ratio doesn't fall because houses get cheaper. It falls because the value of money itself, paper money, or in this case the dollar, is being measured against a metal that can't be printed. When central banks expand the money supply, more dollars chase the same number of homes. Home prices in dollar terms tend to rise. Silver, historically, has had a habit of lagging behind during the early stages of monetary expansion, and then catching up violently in the later stages, once investors lose confidence in paper currency and start moving toward hard assets. So when the ounces needed to buy a house number starts dropping quickly, it isn't because real estate is getting more affordable. It's because silver is starting to reprice, faster than the dollar-denominated price of the house itself. History gives us another clue. This isn't a new phenomenon. In the 1970s, as the US abandoned the last remnants of the gold standard and inflation accelerated, silver moved from roughly $2 an ounce to nearly $50 an ounce by 1980, an extraordinary move in less than a decade. During that period, the amount of silver required to buy an average home collapsed dramatically, not because houses became cheap, but because trust in the dollar was eroding and hard assets were repricing against it. Then, once the Federal Reserve under Paul Volcker raised interest rates aggressively to crush inflation, silver collapsed just as fast as it had risen, and the ratio reversed again. The lesson isn't that silver always goes up. It's that this ratio is sensitive to something deeper than supply and demand for a metal. It's sensitive to confidence in the currency itself. That's only part of the story. There's a second force at work here that has nothing to do with the Fed. Industrial demand. Silver isn't just a monetary metal. It's a critical input in solar panels, electric vehicles, electronics, and a growing list of green energy technologies. Unlike gold, which mostly sits in vaults, a significant portion of mined silver is consumed every year and never returned to the market. That means the supply of investable silver, the part that competes for monetary demand, has been shrinking relative to demand from industry. If global manufacturing and energy transition trends continue, that creates a structural tension. Industry needs more silver every year, while monetary demand can spike unpredictably whenever confidence in currencies weakens. Two different kinds of demand, pulling on the same limited supply. Now here's the signal very few people noticed. Most investors don't watch silver until it's already moving. By the time it's in the headlines, a large part of the move has often already happened. That's the pattern smart money tends to avoid. Instead, experienced investors watch ratios, gold to silver, silver to housing, silver to wages, because ratios reveal shifts in relative value before the dollar price confirms it. When a long-suppressed ratio like ounces per house starts moving quickly, it often means capital is beginning to rotate out of paper assets and into hard assets, well before that rotation becomes obvious in daily price charts. This is the part of the story most people miss, not because the information is hidden, but because it requires patience to notice a trend before it's loud. If you're finding this kind of analysis valuable, consider subscribing to the Collapse Signal. Every week, we break down the economic signals shaping global markets before they become tomorrow's headlines. And if this video is helping you see the bigger picture, a like helps more people find thoughtful analysis instead of speculation. So where could this go from here? If history is any guide, there are a few broad paths. 1. If inflation reaccelerates and confidence in fiat currencies weakens further, the ratio could continue falling quickly, echoing the 1970s pattern as silver reprices faster than real estate. 2. If central banks succeed in controlling inflation through high interest rates, silver's monetary premium could fade, and the ratio could stabilize or even reverse, similar to what happened after 1980. 3. A slower, grinding scenario, where industrial demand keeps a floor under silver prices even without a dramatic monetary crisis, causing the ratio to decline gradually over many years rather than collapsing suddenly. No one can say with certainty which path plays out, but understanding the mechanism means you don't need a perfect prediction. You need to recognize the signal early enough to respond. A few things worth tracking if you want to follow this story going forward. Real interest rates. When rates fall below inflation, hard assets historically tend to outperform. Central bank gold and silver buying, particularly outside the US. The gold-to-silver ratio itself, which tends to compress sharply during periods of monetary stress. And broader signs of currency confidence. Bond market behavior, debt levels, and how aggressively governments are expanding money supply. None of these guarantee an outcome, but together they form the kind of picture that's far more reliable than reacting to a single headline. So here's a question worth sitting with. Do you think this signal is being ignored by most investors right now, or do you think it's already priced in? Would you buy, wait, or stay on the sidelines? Drop your take in the comments. I read every one. The number of ounces it takes to buy a house isn't just a curiosity for silver investors. It's a window into how money itself is being valued. When that number moves slowly, it tells you very little. When it starts moving quickly, it tends to mean something has shifted beneath the surface, in confidence, in policy, or in the balance between paper promises and real, tangible value. Markets rarely reward those who react to headlines. They tend to reward those who recognize the signals before they become obvious. The real question isn't whether change is coming, it's whether you'll recognize it in time. If you found this analysis valuable, subscribe to the Collapse Signal for more in-depth market breakdowns. Like this video if it helped you see the market differently, and share your thoughts in the comments. And if you want to stay one step ahead, watch the next video on this channel, because the next signal may already be forming.